Good morning, everybody. So I was very fortunate to be able to come here to Vilnius 2 years ago to present an overview of our then new macroprudential measures, which had been introduced from February 2015. And I'm delighted, and my thanks to Thomas for inviting me back 2 years on to provide an update following quite a detailed review of the impact of the measures that we undertook. The review was undertaken during the second half of last year. So let me this morning first provide a very brief recap of the measures we introduced in 2015, including in relation to objectives, rationale and design, and then I will spend most of my allotted time on some select issues relating to our review, including scope, the range of analytical and policy projects, the call for evidence or public consultation undertaken, and of course some key findings from our evaluation and some amendments that were introduced. So as a brief introduction, our borrower-based measures in the form of LTV, LTI caps were announced in October 2014 and introduced from February 2015. In line with established procedures for other macroprudential instruments, notably the countercyclical capital buffer and the OC buffer, we were also committed to regular, in this case annual, reviews of the impact and the effectiveness of the measures and the appropriateness of the calibration of the parameters. And the findings of this review, as I say, were published last November, including some changes to the measures. And it was, of course, fully understood that it was very early to be evaluating the impact of these measures only 18 months after their introduction, but we thought it was worthwhile to do so for a number of reasons, and both the review process and the results threw up some interesting findings, and these are what I want to share this morning. So very briefly, our measures as initially designed set out a maximum loan-to-value of 80% for non-first-time buyers. For first-time buyers, a higher cap of 90% initially applied for house purchases for the first €220,000, and the 80% LTV then applied to that part of the value of the house above €220,000. Regarding a proportionate element, so some lending is allowed above these limits, and more precisely, in the initial design, no more than 15% of the value of new lending was allowed to exceed the LTV caps. And we apply a more stringent limit to the purchase of houses for investment purposes, and here the limit is 70% LTV to be exceeded by no more than 10% of the value of new lending. In terms of the loan-to-income ratio, this is somewhat simpler, so a maximum LTI of 3.5 times is allowed, subject to up to 20% of the value of new lending allowed above that limit. And this only applies to primary dwelling homes, so there's no LTI limit for investment purchases, and we also have some other exemptions for negative equity mortgages, for people switching mortgages, and for mortgages in arrears that are under restructuring. Our two primary objectives in introducing these measures: first, enhancing the resilience of banks and households to economic and financial shocks, and second, reducing the pro-cyclicality that can be inherent in housing and credit markets by capping the number of high LTV and LTI mortgages that are allowed at any time. In addition, the measures create a framework which allows for some degree of leaning against the wind by tightening or loosening the parameters, and these parameters could be either the thresholds themselves or the number of allowances above the thresholds. And we were conscious also that for reasons of legitimacy, given the obvious welfare and distributional implications, the design of the measures need to be able to stand the test of time to become a generally accepted standing feature of the mortgage market over time. Incidentally, we have tried to be very clear to communicate that it is not our target, or not our objective, to target house prices. In fact, this has been a remarkably difficult message to get across, and there can be a risk, I think, from introducing measures like this, that policy makers get blamed then for all of the ills in the market. So I think the restrictions, or the rationale for restrictions on LTVs and LTIs have been covered in earlier presentations. The ratios, I think, naturally complement each other in addressing different elements of the risk, with the LTI addressing the income or the affordability aspect, the LTV, the equity aspect, or to put another way, the LTI primarily addresses the probability of default, and the LTV primarily the loss given default. Just to show some of the evidence, this is a chart I put up 2 years ago, some of the evidence from the IRIS loan level data. So these charts, all the lines show the outstanding mortgages according to year of origination. So I would draw your attention to the thicker red lines, which are for all mortgages combined. So the chart on the left-hand side shows a positive relationship between the loan-to-income ratios and probability of default. And the chart on the right shows a positive relationship between loan-to-value ratios and the loss given default, with some steepening of the slope at about 80 to 85% LTV. Now, just for fear that I may run out of time before the end of the presentation, I'll just skip forward briefly towards some changes to the measures that were introduced following the review last year. So first, the property value threshold of $220,000 was removed, so that a maximum 90% LTV now applies to all first-time buyers, regardless of the value of the house. There were no changes to any of the other LTV requirements for non-first-time buyers or investors, nor to any of the parameters of the loan-to-income caps. But the second change related to the structure of the allowances, which was also amended, such that there are now separate allowances for first-time buyers and non-first-time buyers. So for non-first-time buyers, 20% of the value of new lending is now allowed above the 80% LTV, while for first-time buyers, no more than 5% of new lending is now allowed above the 90% LTV. And at the end, I'll come back to discuss a little bit more some of the more technical changes as well as the rationale for these changes. So our first review had two aims. The first was to examine the early performance of the measures against the stated objectives, and second, to examine possible side effects or unintended consequences of the measures since their introduction. Specifically, the analysis aimed to inform on, first, a market overview, looking at trends in the housing and mortgage markets in the lead-up to and following the announcement and the introduction of the measures. Second, the impact of the measures on borrowers, including on their ability to access the mortgage market, also how banks have been allocating the mortgages that are allowed above the allowances. Third, the early performance of the measures against the objective to enhance the resilience of banks and borrowers to financial shocks. Fourth, the performance of the measures against the objective to reduce the risk of bank credit housing price spirals from developing in the future. And finally, some unintended consequences, including potential interplay between the measures in the rental sector and unsecured lending markets or leakages for the measures. Now, just for the next, I'm conscious of time, so for the next, time reasons, I'll skip through these next three slides. They are available for your information when the presentation is uploaded. The first provides an overview of the micro data that were available to us and which were an invaluable resource for our analysis, including very granular loan-level data that we've been collecting since 2010, plus data that is now specially collected under our monitoring templates for the new regulations. There's a second slide that provides for your information or to take away a summary of a select number of the analytical or research outputs from the review, including some of the key findings. All of these publications and others are available from the website or on request. And third, and quite interestingly, we provide also on this slide evidence and feedback from external stakeholders. So we undertook a public consultation on the impact of the measures. We were very clear that what we were looking for was evidence-based submissions, and some of the details are there. For time reasons, I apologize that I might move on. So I might dwell a little bit more on this slide. So this slide shows an overview of some of the key findings. We found first that introduction of the measures had an immediate and material and causal impact in moderating price expectations. Actual price is also moderated, although it's more difficult to ascribe any causality to our measures. There was some reduction in high LTV and high LTI mortgages granted after introduction of the measures, although mean and median LTVs and LTIs actually increased. And this, we think, was mainly due to higher prices in the latter period. But interestingly also, there was also some evidence of maybe upward drift of lower LTIs in particular towards the thresholds, which may be an issue of concern if the banks or borrowers are treating these limits as targets rather than as maximums. Some minor changes in borrower characteristics were recorded, most notably a modest shift in the composition of lending towards higher income couples or towards higher income borrowers and couples. Simulations from loan loss forecasting models indicate that the resilience of banks and households increased following introduction of the measures due to the impact on probability of default and loss given default. There's some interesting differences in the characteristics of borrowers granted allowances, that is, the mortgages allowed above the LTV and LTI, which hopefully I can touch upon. Also, previous findings of lower credit risk for first-time buyers compared to movers, these were confirmed. The review also found that this held at all price levels, which was important for our analysis. And finally, the impact on the rental market was an important part of our review. I won't have time to discuss it this morning, but our findings were that rents appear to exceed levels justified by fundamentals, but there's no evidence that our measures contributed to any change in the trend in rents, which predates announcement of the measures. And finally, no evidence was found of an impact of the measures on non-mortgage credit or other leakages. So let me briefly, as time allows, go through a couple of these findings. On this slide here, the left-hand side looks at the impact on price expectations as measured in a quarterly survey of property market participants that is undertaken by the central bank. So the measures were first announced in October 2014. We draw the dotted line at that date on the horizontal axis. The vertical axis shows the median expected percentage increase for 3 periods, namely current quarter, 1 year ahead, and 3 years ahead. And the chart shows a quite significant immediate moderation in price expectations, both for Dublin and nationally, from the date the measures were announced. In terms of causality, we also asked participants for the main reasons underlying the change in their expectations since the previous survey, and the main reason related to the introduction of the measures. And the importance of the expectations channel in the transmission mechanism is highlighted much in the literature on these type of measures, so I think this is an important finding. On the right-hand side, we show actual price developments. You can see first the sharp rise in prices in 2012, 13 and 14, which motivated our introduction of the measures in the first place, and then the rather sharp and welcome drop from end 2014, which coincided with our announcement of the measures. But while we think our measures played a role, including through an expectations channel, for methodological reasons we cannot ascribe any causality to the measures, and in fact we think supply developments are and have been for a while the main driver of prices in Ireland. Incidentally, house prices have picked up again recently, but are now around 10 to 12% rather than 20+% that they were at the time of introduction. Okay, I just need to be a little bit selective in terms of which charts. Regarding borrower characteristics, at the end of the presentation in an annex, there's a number of slides looking at changes in borrower characteristics and distributions. Those charts are unconditional. We also looked at the impact on LTV and LTI ratios controlling for other borrower characteristics, including age, employment, gender, region, house price, etc. The results are on this table. The units are percentage point changes in LTV or LTI. The top half of the table shows that mean LTVs and LTIs were actually somewhat higher after introduction of the measures, reflecting mostly, we think, the higher prices in the latter period, but maybe also some element of the thresholds being seen as targets. But on the bottom half, you can see that for higher leverage borrowers, that is above the thresholds, the impact was negative for both LTVs and LTIs. Okay. One of the features of the design of the measures was to allow a specified number of mortgages above the caps. It was informative to look at what type of borrowers were receiving those mortgages, and interestingly, this varied across the LTV and the LTI. So for primary homes, the LTV allowances tended to be allocated to higher income borrowers, more couples, more in Dublin, the capital city. Whereas for the LTI allowances, these were more likely to be younger, single, lower income borrowers, albeit also in the capital city. Indicative, we think, of banks allowing higher income multiples to younger borrowers with good potential for income growth in the year ahead. So the remaining charts relate to bank and borrower resilience. I might just skip a little, maybe focus finally on this one. So, as with some areas, it goes without saying it's extremely early to be able to expect any marked change in resilience after 1.5 years. Over time, we do expect to see an impact on resilience through the channels of less lending at higher LTV and LTI, leading to lower probability of default and loss given default. And these charts are maybe more indicative of the type of framework we will be able to utilize in future reviews using our loan loss forecasting models. So the left-hand side compares affordability of mortgage repayments as represented in the debt service ratio from 2006 compared to 2016 is the other year, I haven't marked it there, under separate income and interest rate shocks. So the income shock is a 20% drop in net household income. The interest rate shock is an increase of 240 basis points. And the chart groups loans into 3 categories after the shock. First, the blue components where the debt service ratio is below 35% both before and after the shock, the resilient group. Second, in red, where the debt service ratios originated below 35% but rises above after the shock. And finally, in green, where the debt service ratio was already above the threshold before the shock or vulnerable at origination. On the right-hand side, probably more relevant actually to the impact of the measures, looks at the change in the probability of default over time. And on the very right-hand side, you can actually see some reduction as a result of the introduction of the measures in 2015, 2016. Okay, I'm getting the sign just to wrap up. So, other findings related, as I say, with this very important finding in relation to lower credit risk for first-time buyers. It's an extremely robust finding that we have. We found in the current analysis it applies at all house price levels. This was very important in justifying from a financial stability perspective the higher LTV for first-time buyers and now extending that to all house price levels. Okay. So just to wrap up, take one more minute, less maybe. So just 2 changes I mentioned, 2 important changes. The property value threshold removed. One reason for this is that as house prices increase over time, without changing this fixed nominal threshold, it would represent an effective tightening of the measures. It was not clear what basis we would have if we wanted to recalibrate that 220,000 over time. We thought for consistency, to reduce complexity and uncertainty, it was easier to remove that threshold. And apart from the lower credit risk, the impact of this change is mitigated by the fact that irrespective of the value of an LTV threshold, the LTI ratio was found to be a significant constraint on first-time buyers from taking on higher value-added properties and taking on significantly higher leverage. And the reason we made the second change to the structure of the proportionate caps, we feel that by differentiating the allowances of first-time buyers and second and subsequent buyers, this allows for more precise calibration of the rules by borrower type in the future if we want to tighten or loosen by changing these allowances as opposed to changing the thresholds themselves. And we think there may often be good reason for doing it that way. And the lower limit for lending under the lower allowance above the FTB cap also reflects our view that lending above 90% should only be undertaken in exceptional circumstances. So I might keep any other points then for the discussion. I think I've already gone slightly over time, so thank you very much.